The world economy didn't suddenly break in 2025. It's been cracking for years, and the fixes we're reaching for could make things worse unless we get the design right. Adeyemo and Zoffer argue that the United States has repeatedly reshaped the global system, first after World War II, again in the 1970s, and now in a new, more unilateral turn, creating both stability and strain. The big question is, how do you repair a system that millions rely on, more like billions, without smashing what still works? So a bit of a disclaimer, this is a summary of the author's opinions from The World Economy Was Already Broken. This is September-October of 2025 in the Foreign Affairs, and the authors are Wally, Adeyemo, and Joshua P. Zoffer. So with that being said, the core lesson of their essay is twofold. First, the populist trade medicine risks undermining the United States' real strategic advantages, especially the dollar and U.S. services, if it's applied crudely. Secondly, there is a better way. Basically, they propose a fair trade customs union with like-minded economies that set high labor, environmental, and rule of law standards while allowing narrow national security carve-outs. That structure would basically channel rivalry without detonating the whole trading system. So to walk back a bit, in 1944, Bretton Woods yoked the system to the dollar and fixed exchange rates. Multilateral in form, it was U.S. tilted in function. And in 1971, Nixon cut gold convertibility, then George Shultz helped re-internationalize through capital account opening and the G7. Today, the third reordering looks more overtly unilateral, with sweeping tariffs that batter what's left of the rules. The authors concede those shocks spotlight real failings like deindustrialization, state subsidies abroad, WTO paralysis, but warn that the cure can't be indiscriminate. So what actually underwrites U.S. power? And their answer is the dollar's centrality. It sits on one side of nearly 90% of foreign exchange trades and more than half of SWIFT payments. That network effect gives Washington unmatched sanctions leverage and lowers borrowing costs for everything from defense to social programs. Shake investor confidence with tariffs, deficits, and policy whiplash, and you weaken the dollar just as debt services rise, and that's not a smart trade-off. So another overlooked asset is basically the U.S. services economy. So the United States ran nearly $300 billion services surplus in 2024. Fintech rails, software, AI models, cloud, and design. These are export engines that complement advanced manufacturing. Reindustrialization is still vital, but modern factories are capital intensive and automated. The job growth is often around the shop floor, for example, like in maintenance, design, logistics, and digitally enabled trades, more than it is on that shop floor. A strategy that pits making things against services is a false choice. So what's the constructive alternative? Adeyemo and Zoffer sketch a fair trade customs union where members commit to high standards of labor, environment, and rule of law and market-oriented regulation, and refrain from bigger-than-neighbor tactics such as blanket subsidies, tax undercutting, and dumping. Non-members that meet good enough standards face low incentive-creating tariffs, for example, like 5%, and then chronic rule breakers face stiffer barriers. Governance would be flexible, as in like a majority or weighted voting like the IMF, so rules could still evolve, which is contrary to how the WTO has basically a consensus voting choke point. Limited national security carve-outs would allow targeted subsidies or higher tariffs for truly critical goods and coordinated to basically avoid subsidy races. And why the urgency? So because geoeconomics has shifted, China has turned its scale and choke points into leverage, and now the largest trading partner of roughly 120 countries. Left alone, today's anything-goes incentives will entrench anti-competitive norms. A club that offers real market access and credible penalties wouldn't give rule-abiding economies room to reindustrialize together without blowing up the system. So, in conclusion, the takeaway isn't basically bring back 1995. It's protect what truly makes the U.S. strong, being its currency, services, and innovation, and build a standards-based coalition that welcomes joiners, disciplines spoilers, and reserves security tools for genuinely strategic sectors. Tariffs can be a tactic, but a better architecture is the strategy. If basically you want the full blueprint and kind of more of the historical details, I recommend going and reading the article yourself. Again, that is written by Wally Adeyemo, who is a Carnegie Distinguished Fellow at Columbia University, and then Joshua P. Zoffer, who's a fellow at Stanford. And then this article was in the September to October 2025 edition of this past Foreign Affairs. With that being said, I will see you guys on the next one.